Assalamu alaikum. Welcome to lecture 6 of taxation. So from lecture 5 we are moving on to a new type of income. Lecture 5 I have covered employment income. Now I'm moving on to a different types of income. This is for self-employed. Okay. So now we are from employment we are shifting to self-employed. So in this lecture we are going to go through the badges of trade. What are the badges of trade? Then how do we assess for the self-employed? We go by the tax year basis. If we use provisional figure, how do we assess new businesses? How do we assess when a business closes down? And transitional profit. Then cash and accrual basis. So income and expenses under cash and accrual basis. Then we have what is known as simplified expenses. Then adjustment of profit. See, sole trader, for employment we have income. We have salary, we have benefits. I've covered in the previous lecture. But for a self-employed, they will be having profit. Okay, even self-employed profit are taxed as non-savings at the non-savings rate. They will come under non-savings. This is a new category of income. So adjustment of profit. How do we assess at the profit? Then the proforma. What are the general principles of profit adjustment? Disallowable expenditure, capital expenditure, expenses not wholly and exclusive for the trading purpose, you can't deduct from your profit. And appropriations by proprietor. Pre-trading, that means before you start trading, the expenditure. Now, then the conclusion. How much of the syllabus we have covered? Summarize the entire lecture and what technical articles you must read. So now, remember this section is a big section and you have to be thoroughly good in this, because if you're not good, it's very difficult for you to survive at ATX, because in ATX there's a big portion just on self-employed. In fact, there are more to it. This is just the basic we are going to study in this level. And in your tax, definitely you are going to get a question on self-employed. How we are going to, so each type of income will be tested. Whatever this lecture, there are different lectures on different types of income. One was a property income, that will be tested. The other one is investment income, that will be tested. Then employment income, that will be tested. And this self-employed, this will be tested. You will get a question on this. Okay, so here this is a graphical representation of what I've just explained. Badges of trade. To know whether you fall under employment or self-employment. Then how do we assess for a business that is new and when a business closes down? Then the cash basis and accrual basis. Then how do you adjust the profit? The proforma and all the principles. Then the disallowable expenditure and the pre-trading expenditure. So these are the 6 areas we are going to cover in this lecture, and this 6 area you have to be a pro in this. Okay, you will be getting a question on all the 6 areas in a single question. So now, starting with the badges of trade. See, when you are self-employed, either you are carrying on a trade or a profession. Okay, you are an unincorporated trader. Corporation is the next thing. When you incorporate, that means from a sole trader and partnership when you change to a company, that is incorporated. That will cover later. That is not under income tax. That when you are incorporated, when you are turned into a company, then the profit that you get, you have to pay corporation tax on that, not income tax. But when you are unincorporated, okay, that means you are a sole trader or you are a partnership, you have to pay income tax. Okay, so the profits that a self-employed person earns, they have to pay income tax on that. Okay, and they are taken as your trading income, which is your non-savings income. Remember that proforma non-saving saving dividend in the first lecture I've introduced there. This is trading income. Okay, so sometimes by statute, by law, you can't say that this is a trading activity or not. Okay, but there are some badges of trade which says that this is a trade or not. Now, where an activity in the nature of trading is short-lived or based on a small number of isolated transactions, HMRC will apply badges of trade test. That means they want to know whether the profit that you have earned is a trading income or a capital gain. Okay, because if your activity is investment, it will be a capital gain, not trading income. It's very, very, very important that you clearly classify your income as trading income or capital gain. You need to correctly classify that. Based on that, you have to pay tax. If it's a trading income, you pay income tax at 20, 40, or 45%. If it's not dividend. And if it's capital gain, you pay at the two rates. Okay, you pay CGT, capital gain tax. We haven't covered this yet in tax, so leave it for now. I'm not going to discuss the rates now. So badges of trade. They are tested by HMRC whether profit is trading income or capital gain. Now, moving on to the badges of trade. Okay, remember, one badge of trade will not give will you cannot come to a conclusion based on just one particular badge. There should be a number of badges. You have to see the overall picture, whether it's a trade or not. Okay, a brief meaning of each of them. So these are your badges of trade, and brief meaning is given here. First one, profit motive. I have highlighted it in bold. Okay, first one is profit motive. Profit motive. So profit motive might not be unique to just trading. Why? Because if you are holding an asset as an investment, you still seek to make a profit on the disposal. Okay. Next, the length of ownership. But still, profit motive is essential in case of trading, even though it is not unique. But still, when it is trading, your ultimate motive is profit motive. But when it is an investment, for example, you are holding a property, there could be more than profit motive. For example, your motive could be capital gain also. Okay. Next, the length of ownership. So the next trade, badges of trade is you have to see the length of ownership of the asset. If it's a shorter interval means it's trading. That means shorter interval between the time you have purchased and you have sold. Because the longer time you are holding it, it is capital in nature. Because if you see trading, most of the time, quick turnover of inventory. You quickly want to sell your inventory to realize a profit. That is the essence of inventory. That's an essence of trading. So this two, the third one, subject matter. Some assets are more likely to be trading inventory, which can only be turned to advantage by a sale of by a way of sale. That means for some, you can only it can only be to your advantage if you sell it. By holding it, you are not going to get any benefit. So it's a trading. Because some assets you can't hold it for investment purpose. Next, the method of accusation and the reasons for the purchase or sale. They are one only. Okay, so why did you make the sale? If you're deliberately acquiring, then it could be a suggestive of trading. So let's say you are making a sale, and forced sale. So that sale you are making so that you can meet up your unexpected financial difficulty. This is interpreted to be trading, because if it's an investment, you don't make sudden sale. Okay. Next, the method of financing. So if you are borrowing a money for short term, it is more like trading. Next is the similarity. You see whether there is any similarity. So the similarity, if there are any similarity, it is trading. Similarity of the transaction. Then supplementary work. Supplementary work performed on the asset to make it more saleable. This is associated with trading activity. For example, you are repairing it. You are cleaning the second-hand good before the resale. All these are example of trading. Number of frequency of similar transactions. So if you are recurring similar transaction, it's more like trading activity. So this list, the bullet points are the badges of trade. Make sure that you know all the badges of trade. Now we'll apply all that in this question. Activity 1. So here we have the question, and on the next slide is the answer. I have taken the copy paste from your study hub. Now, so on 6th April 2024, Andrew Wall purchased a daily rate office building for 100,000. Legal fees was 800. Now, during the tax year, renovated the office building for a cost of 60,000. The renovation was completed on 15 Jan 2025. He immediately put the office building up for sale and it was sold on this date for 2225 and legal fees was 1,000. Now, Andrew financed the purchase and renovation cost using the 3-year bank loan 160. Annual rate 13. Andrew is employed as a school teacher and his taxable income is 48,000. Andrew purchased the office building with a view to make a profit because it is an isolated transaction. He believes that the profit will be treated as capital gain rather than trading income. So now he is thinking he should treat this as a capital gain rather than trading income. Now you, using the badges of trade that you have just learned in the previous slides, you have to give reason whether it is a trading income or a capital gain. You are not required to perform any calculations or to quote from any decided cases. You have to apply all that here. Okay, so let us go here. So how many were there? 8. Okay, first we went through the profit motive. So here clearly they told that the main activity they have undertook is to make a profit. Okay, next. But here if you see, even though he undertook the activity to make a profit, but from this case you clearly cannot understand why. Maybe the activity was mainly for an investment purpose and he wanted to make a profit there. So you can't say that is for trading income only. Next, what is the subject matter? Okay, so if you see, it's a building. Okay, buildings usually appreciate in value. Okay, it's an appreciating asset building. Most of the time people hold investment in building, it's an investment. Mostly they don't go for trading. But in this case, the fact, see how they are using the case study, the fact that it is a daily receipt office building, it could be subjective of trading. Okay, length of ownership, the third factor. So here if you see, they have sold it in a short period of time. Within 12 months he has bought the property and sold, so it's an indicator of trading motive. We'll see frequency. Before he did not enter into this transaction. Okay, but that's why this badge suggests that it's not trading. This badge suggests it could be capital gain. Supplementary work. So renovation was done there. Okay, and this was done so that you can sell it at a profit. Next, circumstances. What is the circumstance of sale? So here they have deliberately purchased, then they have quickly sold it. Mostly it is suggesting that it's a trading motive. But in this case, the sale was not an enforced one. Normally you have taken it in the normal course of trading. This also suggests it's a trading motive. Okay. Next, finance. You have used short-term loan. So short-term loan means mostly is for trading because they told 3 years loan. Next, enters employment. See, if you see his job activity, selling of building and all, clearly it is not telling you anything, whether it is a trading or an investment. But if you see his salary level, he has a salary of 48,000. Okay, so this would support that Andrew would never intend to hold the building as a long-term investment. If you see his salary level, it looks like it is a trading income. This is a trading income. So what is the conclusion? If you see, more points are towards trading. Okay. See, when you can't come to a clear conclusion, there are some badges of trade where you cannot come to a clear conclusion, like profit motive, like length of ownership. So here, yes, he might have undertook the transaction to turn a quick profit, but automatically you can't say it's a trading activity. So here he has to make sure that if he does not repeat this process in the near future, then it's a one-off investment. So this is like an open-ended. You are leaving it open-ended. You are not saying it's a capital gain or a trading gain. You are saying if this happens, it could be a one-off investment. Now, moving on to the second part of this lecture. So we have finished the first part, the badges of trade. From there, we are moving on, assuming it is self-employed. Okay. What is the basis of assessment? Like how for property income we have done cash basis, accrual basis, here also we have like that. So this is a tax year basis. Based on the tax year, we'll charge them. Okay. When self-employed, they start to trade, they are going to prepare accounts, which is known as, they prepare the accounts for a period of account or the accounting period. Either it's called period of account or the accounting period. And this can have, see, this accounting period and tax year might not be same. They might have different year ends, okay? Because you can choose your own accounting date. It could be end of the year, December, it could be July, it could be any day, okay? So they can choose to use the tax year as their accounting period. They might even use the tax year as their accounting period. They can choose to do that, but they don't necessarily do that because there's no obligation for you to do that. But from the tax year 24-25 onwards, which is the tax year that you are going to follow for your upcoming exam, both sole trader and partners are assessed on a tax year basis. Earlier, this was not there. Earlier, you have to apportion profit. Then there were rules, overlap profit. Now that overlap profit is wiped out because you will be charged on a tax year basis. That means any profit arising from 6th April to 5th April or from 1st April to 31st March. This is regardless of which accounting period they use. You can use any accounting period, but your profit will be taxed from 6th to 5th or 1st April to 31st March. Arising in this tax year, you will be charged. Now, this is an example. So example 1. There are 2 year ended, 2024 and 2025. So, we are in which tax year? Remember, we are always in 24-25. Okay, so for the tax year 24-25, he will be assessed to profits for 6th April 2024 to 5th April 2025. This is the starting, this is the end. So if you see year ended 5th April 2025, it is in this tax year, this 55,000. Now, it is possible you might prepare accounts, okay, so where accounts are prepared to a date shortly before the tax year end. You might even end it before the tax year end. Okay, let's say rather than 5th April, you are choosing 31st March. So in this case, the late accounting date rules effectively mean the period of account can be taxed in that tax year as if the year end was 5th April. So you are assuming the 31st March as 5th April. Okay. 6th to 5th, you are assuming it as 5th April. It's not going to affect so much. So a business can still choose an accounting date which is not 5 April also or 31st March also. So where you prepare account which is not 5th April or 31st March, your trading profits have to be time apportioned because it's in the tax year. Some might be in this tax year, some might be in the previous tax year, some might be in the next tax year. Tax year is the one which matters a lot. So here, previously there were several factors which affects your choice of accounting date. But from now, for you, this will not be tested any longer in your tax. Why? Because it doesn't matter. You will be taxed on the tax year. Okay. Now there are no longer any tax factors which influence your choice of accounting date. So if you're having your accounting date as 5th April or 31st March, it is better for you because then you don't have to apportion any trading profit. It is very straightforward. It aligns with your tax year also. So we'll go through example 2. Now Graham is preparing accounts to 31st December each year. Okay, he's trading profits for 24 and 2025. So for 24-25, you have to apportion because both of this profit falls in that tax year. Some portion of this, some portion of this. So from 6th April 2024 to 5th April 2025. So if you take from April to December, 9 months from here and 3 months from here. So 9 months of 60,000 and 3 months of 65,000. If you add together, this is your profit for 24-25. 6th April 2024 to 5th April 2025. It is very easy, very straightforward. And the same rule is there for ATX also. No difference, nothing. Next, use of provisional figures. If a trading profits needs to be time apportioned. See, you only have to time apportion when you're preparing accounts, not 5th April or 31st March as the year end. Then only have to time apportion, which is most likely to appear in your exam. Because examiner wants to always test whether you can time apportion or not. Okay, so it is quite possible in this case that figures for the second accounting period will not be finalized or even prepared before the related self-assessment taxation needs to be submitted. Okay, so the final deadline for the submission of self-assessment return and payment of tax for 24-25 is this: 12 months after the filing date, that is 31st Jan 2026. Someone who prepares accounts to 31st December, okay, they will need figures for the 3 months of the year ended 31st December 2025. Why? See the year 31st December 2025 to 31st December 25 to 31st Jan 26. Okay, this is the deadline and you are preparing account 31st December 2025. So for this runs from 6th April 24 to 5th April 25. So you are preparing for 31st December 2025 and tax year ends on 5th April 2025. So from 31st December 25 to 5th April 25. 3 months. There are 3 months in between. So you will need figure for the 3 months. But it is unlikely that this will be finalized in time to submit the tax return. So when you have to submit the tax return for this is the deadline, 31st Jan 2026. By this time, it's very unlikely that this account will be finalized. So in this case, you have to use provisional figure. That means estimated figure. How are you going to get this estimated figure? By using your trading profit for the second accounting period based on this. So once the figures are finalized, remember the self-assessment tax return, you have to amend it. It will change. And you can do this change within 12 months of the filing date. That is by 31st Jan 2027. Because this is the deadline, amendment deadline for the tax year 24-25. Remember this deadlines and the days of filing, very important. Very important. Next, so we are moving on to the new business. Okay, so all this provisional figure and all easily we can use for continuing business when you're in the business for many years. But what if you are a new business? You have just started trading. So in this case, your tax year basis is very straightforward. It starts from the day you start your business till the date of commencement to 5th April 2025. So let's go to example 6. Amit starts trading on 1st Jan 2025. Okay, so he prepares accounts for 10 months. Yes, it can be less than 12 months. Your first accounting period. So M's profit is 32. But remember, you have to time apportion. Why? Only from 1st Jan to 5th April you can take for 3 months. So and this 32,000 is for 10 months. So it is only 3 months you have to take out of 10 or 12 of 32,000. So this will be the profit assessed on this tax year. Now, short accounting period. So if you're a new business, it is most probably that you're going to have a short accounting period, especially your first set of accounts. Even if the profits for the full period are included in this tax year, you still have to pay attention how long the accounting period is. Why? Because even your capital allowances you have to prorate for short accounting period. Okay. What are these capital allowances? We'll soon go through capital allowances. It's a detailed lecture on capital allowances. Now, example 4. So Oliver starts trading on 1st June 2024, preparing accounts to 31st March 2025. Okay. So it's from June to March. 10 months. Okay. So they have given 245,000. Here, you don't have to apportion anything. Straight away you can take 45,000. Because remember 31st March and 5th April. Year end are taken as same. Now, next, long accounting period. If you are starting a business and your first set of account is long means more than 12 months. So here, this is how your business profit will be assessed. From the date you start commencing to 5th April 2024. This should be reported on 23-24 tax return. Then from 6th April to 5th April in this tax return, 24-25 tax return, and from 6th April 2025 to 30th June 2025. Plus the period from 1st July 2025 to 5th April 2026. There are 2 periods that will be recorded in the single tax year. Okay. This is an example for long accounting period. So Andrew start trading on 1st Jan 2024, prepares accounts for 18 months to 30th June. So they have given already the tax adjusted profit for 18 months, 36,000. So from 1st Jan to 5th April for 3 months, out of this 18, for 3 months of 36,000. This day the profit is taxed as 6,000. Then from 6th April 24 to 5th April, normally 12 months. So you have to take 12 months, which is 24. And the last, that means remaining 3 months. 3 months goes here, 12 months goes here. How many months? 15 goes from 18, you are left with 3 months. 6th April to 30th June will be taxed in this tax year. Not only that, along with the 9 months of the profit for the year ended 30th June 2026. Okay, this will be taxed in 25-26. Now, when you're closing down a business, here this is also very easy. So it will run from 6th April to the date you have closed down. Okay, let's go through activity 2. So you have ceased trading on 31st December 24. Trading profit has been given as 44,000. Calculate the amount of trading profit that will be assessed. So you have to take from 6th April to December. How many months? 9 months. So out of 12, 9 months you have to take of 44, which is 33,000. Now, transitional profits. So as mentioned in section 2.1, it's a tax year basis that we follow. Okay, for this. But the tax year 23-24, that is the previous tax year, this was your transitional year from the old current year basis, okay, from the old current year basis of assessment rule, which applied. So this old current year basis applied until the tax year 22-23. So under the old rule, it is possible that your profits are taxed twice, in the opening years and when you are changing the accounting date, which resulted in overlap profits. So now some traders will have overlap profit brought forward on 6th April 2023. This is the start of your transitional year 23. So the transition from the current year basis to the tax year basis should have used all of your traders overlap profit in 23-24. So because you are transiting from current year to tax year, all your overlap profits are used there. Now, so conversely, the change in the basis of assessment may mean that more profits than normal are taxed in the transitional year. Because you are changing the basis from current to tax means more profit are taxed in the transitional year. More profits are taxed in this tax year. So this is known as transitional profit. And this is spread over 5 tax years, with 20% of transitional profits taxed each year. That's how you're going to spread over 5 years. For 5 years, 20% of transitional profits you'll be taxing. So this will start from 23-24 and it will end 27-28. But the spreading of transitional profit can be accelerated. You can accelerate. But it will not be asking tax, but it's there in ATX. Now, example 7. So let us go through example 7. Okay. Ash has acceptable trade profit 23-24 of 84,000, including profit of transitional profit of 40,000. So if you take 20% of that, it is, so the final assessment take for 23-24. So from 84, you have to take 40,000 out because that 40 is transitional profit. And then add 20% of 40,000. 20% of transitional profit you have to take, which is 52,000. Okay. So Ash also has transitional profit carried forward to 24-25. How much? So transitional profit which will be carried forward in 24-25 is from your 40,000. Take 20% and deduct it. 20% of 40 is 8,000. So you deduct it and it's 32. So this 32,000 will be spread over the tax years 24-25, 25-26, 26-27, 27-28. That means 8,000 each tax year. Okay, so 32,000 divided by 4 is 8,000. Each tax is 8,000. Or simply just take 40,000 and divide by 5 because you have to spread over 5 tax years. Still is 8,000. Starting with 24-25. Now, transitional profit. You do not need to know how to calculate the transition profit. Good. But you do need to know how a given amount of transition profit is subject to tax. See, the amount of transition profit will be given to you. You only have to know how to calculate tax on that. If a business ceases before or not before 5th April 2027, any transitional profit that has not yet been taxed must be taxed. Now they'll be taxed. When are they taxing? In the year when the business is ceasing. The transitional profit that are spread over the 5 tax years are treated as a separate component of total income going forward. They are separate. So the extra transitional profit brought in, this can affect your personal allowance. Okay. So this could reduce your personal allowance, including the transition part. Now, example 8 will help you to understand this better. How transitional profit will affect your personal allowance. So your trading profit is 85, transitional profit is 18. So add both the profit. Because you have added, you see your net income is more than 100. So your personal allowance accordingly will reduce. And this is your taxable income. So first 37,700 at 20, balance at 40. Okay, it is given here how personal allowance is reduced. 103, you deduct 100, take half of it and minus it from 12,570. Now the third section, cash basis versus accrual basis. Mostly accounts are prepared using accrual. But for tax purpose, sole trader and partnership could use simplified cash basis to calculate their taxable profit. Previously, cash basis can only be used when the revenue was below 150,000. But now this restriction is not there. Now the cash basis is the default basis. So unless the question says is accrual, always go by cash basis. It is possible for the sole trader partnership to make an election. They can make an election. See, cash basis is a default basis. You don't have to elect. But since accrual is not the default, you can make an election to use the accrual basis to calculate your trading profit. But this election to use the accrual basis will apply until the trader decides to change it out of the cash basis. Until then, accrual basis will follow. Cash basis is not available to limited companies. Companies always accrual basis because it's very difficult for big companies to, the limited companies to go by cash basis. In any question where you have to calculate trading profit, whether for sole trader or partnership, always use cash basis unless the question says otherwise. So examination questions will not test traders moving between cash and accrual basis. This they will not test. Either they will stick with accrual or cash. Now, income and expenses. So what are the differences? So if you're under cash basis, that means actually what you have received only will be recognized. And expenses are only deductible. You have paid for it. And remember that expenses have to be incurred wholly and exclusively for the purpose of the trade. And they are paid in the tax year, otherwise you can't deduct. So because it is on cash basis. Based on what you are paying and receiving, there are no adjustments required for changes in inventory, receivable or payable. Thank God, things are very easy under cash basis. Now, capital items like machinery, computer, vans, but not cars, that are used in the business, you can treat them as trading expenses. They might be capital expenses, but if you're using them in the business, because that's your trade, you can claim them as trading expenses. So because they're trading expenses, you can't claim capital allowance. Remember, capital allowances you claim for capital expenditure, not revenue expenditure. So trading expenses are your revenue expenditure. For this type of expenses, you can't claim capital allowances. So sale proceed that you receive from such assets when you're selling a machinery that are used in the business, that is your trading income. And the purchase cost of the car is not deductible. You can't deduct. Instead, either fixed rate expenses or capital allowances and running cost are claimed on the car. We shall see this in the next section 3.3. What about land and building? So cost of any land and building, they are not deductible under cash basis. And structures and buildings, they will not be available. See section 6.12 and the cash basis. So the cash basis, if you see, it is simpler because tax will only arise on the income that you actually received. If you see from the point of cash flow, it is good for you, it's beneficial. It's giving a cash flow benefit. Automatic relief you are getting for bad debts. There are no bad debts because you are only receiving income when you are actually being paid. Okay, there were previous rules, but now it no longer applies. What was that previous rule? It restricts your interest deductions when you're using cash basis to 500. That means for any loan you are taking, you must be incurring interest on that. That interest you can deduct under cash basis up to 500. But now no longer apply. So previous restrictions on loss relief available when the cash basis was used to calculate those losses, which prevented losses being set against total income or carried back, also no longer apply. That means now, earlier there were difference between cash and accrual basis instead in terms of loss relief and interest deductions. Now both are same, whether it's cash basis or accrual basis. You can deduct the losses against your total income, and also you can carry it back, whether it's under cash or accrual. Third, simplified expenses. All unincorporated traders means sole trader and partnerships. Okay, the self-employed. So all unincorporated traders, regardless of whether using cash or accrual, they have an option of using fixed rate expense deduction, where your expense deductions will be fixed for any or all of the following. First one, business cost of vehicle. This we have covered in lecture 4. So instead of claiming capital allowance and the running cost, there's a fixed rate expense that you can claim for the business mileage. That means up to first 10,000 miles 45 pence, thereafter is 25 pence. Okay, these are same as for employees using their own car for business purpose. If the employees are using their own car for business purpose, it's the same. First, same as self-employed. So here, a fixed rate mileage is claimed for a van. Okay, its capital cost cannot be treated as a trading expense. Now, a consistent approach is required. So once you have chosen a method, you have to consistently use that method. So till the time you're using that vehicle in the business, let's say you are claiming capital allowance and running cost for that vehicle, you have to go by that basis. Or if you're claiming mileage allowance, okay, statutory mileage allowance, you have to go by that basis for that particular vehicle. Now, next is your business use of home. You're using your home for the business purpose, part of your home. So instead of calculating the business proportion of utilities, internet, okay, you deduct a monthly flat rate expense you can claim depending on the hours worked from home. So 10 per month if minimum of 24 hours you have worked at home per month. Up to 26 per month if worked at home exceeds 100 hours. In the exam they will give you how many hours. Now the third, business premises you are using partly as a home. So mainly this relates to the traders such as guest house or bed and breakfast owners. Here also a monthly flat rate expense relating to the private use of utilities, phone, food you can deduct from your total expense. And the monthly flat rate depends on the number of people using that premises. 350 for one, 500 for two, 650 for three or more. So if it's one people, 350, two, 500, three or more, 650. Remember these numbers. Note that these fixed rate amounts do not relate to costs such as rent or mortgage or interest or business rate, where the business portion still needs to be separately calculated. Okay. Next, taxpayer can choose for each period of account whether they want to go by fixed rate deduction or they want to claim on the basis of the actual business usage. This there is a choice. So the business expense for business premises equal to your actual utility phone food cost minus the fixed rate amount plus the business proportion of rent, mortgage, interest and business rates. Make sure that you remember this equation as well. Now, some exam advice. Advice 1. Although this fixed rate simplified expenses are available outside of the cash accounting basis, they will most likely be examined in the context of cash basis. Okay, so fixed rate, cash basis. 2. Advice number 2. A question will state whether approved mileage allowance or actual running and capital allowances are claimed on cars or not. Advice 3. The fixed rate amount for business use of home and private use of business are not given in the tax rates. But if it's necessary for your exam question, they'll be provided. So these are the 3 exam advices you need to remember for simplified expenses. Now, this is how a trading profit or loss under the cash basis is calculated. So this is like a pro forma. And you need to remember this. You need to memorize all your receipt, including the sale of equipment. Then deduct expenses, including the purchase of equipment. And also deduct the fixed rate expense deduction if it's relevant. And deduct capital allowances on car and the car running cost or approved mileage allowances. Remember, it's an or. Either this or that, not both. So either is capital allowance and the actual cost or approved mileage allowance. Whichever you do, you deduct from the receipt. And then finally you end up with your trading profit and loss. Remember, this is under cash basis. Now, the exam advice. So if the question involves the calculation of trading profit under the cash, candidates, the starting figure is the revenue figure for the candidates. Okay, they are expected to compute the profit for tax. as shown in the proforma above, or with a profit figure, or they can start with a profit figure. So example 9. Here, business premises used as home. So Gillian runs a guest house and lives there the entire year with her husband Jonathan. Their daughter is away at university for 9 months but returns home for 3 months in the summer. Total expenses are given as 18,000. The fixed rate amount is calculated as, remember how many people? It's 1, 2 and 3. Since there are only husband and wife. See, 9 months the daughter was away. So the first 2 months is only the husband and wife, 2 people. So the rate is 500 for 9 months. Plus, then there were 3 people. Sophie returns. So then the rate is 650 for 3 months. So the total is 6450. Okay. And the total expense is 18,000. So out of this 18,000, you can deduct this, and this is your total expense. So therefore, Gillian can claim business expense of this much. 11,550. In addition, Gillian can claim for the business proportion of the business rates due on the property, and either the business proportion of the rent or mortgage interest payable. Now moving on to activity 3. Here, you have to calculate your trading profit using both cash and accrual basis. So here you have to use accrual basis B, you have to use accrual basis. Cash basis A, B, accrual basis. And in this, when you're using cash basis, it is the mileage allowance. And when you are going for accrual basis, you are going for actual running cost and capital allowances. Okay. So here, David started a web design business on 6th April 2024. These are the following information for the year ended after 1 year. So turnover is 68, receivable is 5, 1,000 was written off due to bad date. Then office rent is 1,200 per month, 5,600 was paid in the year. April, David purchased a car with an emission of 140, 18,000. Remember the third one is a benefit. Okay. Motor expenses 2,800. Lived off 10,000, 30,000 was business. Motor, office and computer equipment was 9,000, purchased at the start of the year. That means for whole year it was there. And other allowable business expenses 6,000, of which 600 was unpaid at the year end. So now let us solve this question under both cash and accrual basis. So take out any blank workspace on your CB platform and you will get the response option. So we will be doing our calculations in the spreadsheet. All our calculations will be using the spreadsheet. So for activity 3, we are told to calculate trading profit under cash and accrual basis. So first we'll be doing under cash basis. So make sure that you clearly label that it's cash basis. Okay, now. And then sidewise I'll be doing for accrual basis also simultaneously so that you can see the difference. Now, first it's a trading profit. So our starting point under both the basis is revenue. So we start with revenue for both. Okay. So remember for cash basis it is based on the amount received. What was the revenue? It was 68,000. But there were 5,000 debtors and 1,000 that was not paid. Bad date. So you have to deduct those. From 68,000 turnover you have to deduct 5,000 debtors and 1,000 bad debt because they are not paid in cash. But when it comes to revenue under accrual basis, what happens? Wait, this I'll copy paste here. This I'll deduct. Here when I do the revenue, it is 68,000. From here, will not deduct the debtors. Will only deduct the bad debts. This is accrual basis. Okay. See, even though it's debtors, we assume that it is relating to the sales for that period under accrual basis. So we take that debtor also under sales. So you see the difference? Here it is 62, here under accrual basis the revenue is much higher. Okay. Now we deduct the expenses. Okay. So we start deducting the expenses. It's given in order, the 6 points. So sales we have finished, then is the office rental, office rent. So the office rent under cash basis, it is based on the amount paid. So how much was paid? They have clearly told us 15,600 under cash basis. Paste. Wait, this I'll write here 15,600. All expenses under one column. This is revenue. So here the rent is accrual basis. How much for the period? It's 1,200 into 12 because 1,200 for 12 months under accrual basis. 14,400. Now next expense is your car, motor expenses. So we'll write, don't write car, otherwise it looks like assets. Motor expenses. So I'm going to copy paste here. Okay, so motor expenses. How much under cash basis? How much they have received? See, under cash basis it is approved mileage allowance. Okay, and in point number 4 they have given the mileage allowance. It is 10,000. 10,000 is the mileage, but out of that 10,000 only 30% is business usage. So 30,000, 30% if you take off 10,000, business, okay, is 3,000 into 45 pence, because first 10,000 into 45 pence, so 0.45. You can't write 45p here, write 0.45. When you come here, motor expense, they have claimed capital allowance under accrual basis. Okay, so here they have given the expenses as 2,800. So you have to take 30%. Only the business portion you can claim capital allowance into 2,800. Done. Next, after motor expenses, what's next? We have other expenses. We have equipment purchase. Remember, under cash basis, equipment purchase you can deduct. So equipment. Equipment that was purchased. But equipment purchase you can't claim under accrual basis. It's a capital expenditure. So how much did you purchase? It was 9,000 at the start of the year, so no need to time apportion. Here, equipment 9,000 you can't deduct, but rather you can claim capital allowances. Okay, for the equipment. So capital allowance. What is capital allowance? See, capital allowance, because this equipment is a capital nature of good. Okay, when you buy it, they are giving allowances. Allowances means it will help you to reduce your tax further. Because you are purchasing on this equipment to run your business, government is giving it, it's like an incentive, tax incentive. Your tax will be reduced because of this capital allowance, because you can deduct this from your trading profit. But this capital allowance is only on your capital expenditure. For example, if you buy any kind of plant and machinery, equipment, furniture, cars, computer, like that. So here on this equipment, it's a capital nature. On this you can claim capital allowance. Capital allowance itself is a big section which we are going to cover. Okay, fully. It is the There are various types of capital allowance, but for now it is AIA. What is AIA? For now, you know that this is an annual investment allowance. Annual investment allowance means every year when you are buying, you are going to get an AIA, known as annual investment allowance. There is an amount to it, fixed amount. That means up to this much, if you expend, you don't have to pay any tax. Totally, you can deduct from the expenditure of that item, which is 100%. EIA is 100% on the expenditure, but there is a limit. But this 9,000 is much below that limit. Okay. So this is 9,000. So when we go to AIA, we'll know the limit of AIA. Okay. It is some 2 million, the limit. So, but here this is 9,000 is much smaller. So entire 9,000, the cost that you have incurred while buying the equipment, you can deduct the entire amount by claiming capital allowance 9,000. But this capital allowance you can only claim under accrual basis, not cash basis. Cash basis you can deduct. Why you're not getting this capital allowance under cash basis? Because you are deducting 9,000. So this or that you are still, it is same. Maybe the terms are different under the name. Under accrual is accrual basis capital allowance, under cash basis the full equipment cost you are deducting. So it's the same. Now remember, you have bought a car. On that car also you are going to get capital allowance. There are various rules for capital allowances for various type of assets. Okay, this is for car, and this capital allowance is for equipment. You have to always name for which asset you are taking the allowance for. Okay, so car, what is the cost of the car? It was 18,000. You purchase a car with 18,000. Remember, only the business portion, you can only take 30%. Okay, and based on the CO2 emission. So this is capital allowance. It's 140. If your car is below 50, above 50, it comes under special rate pool. All the special rate means the percentages are lower under that. That means low amount of capital allowance you can deduct. It's another form of capital allowance, like AIA, annual investment allowance. We have WDA, written down allowance, on the amount of the car. So it's because it's 140. Looking at the emission, 140, it is 6%. So on this 18,000, only business portion 30%, and you take 6%. For timing, you can even leave this question alone if you're not understanding these capital allowances, because I have not touched this capital allowance yet in tax. Don't worry. And then under cash, we straight away deduct other expenses, the last point, allowable expenses. How much? It was 6,000, but unpaid was 600. So from 6,000, you deduct 600 under cash basis. But under accrual basis, full 6,000. Because it is relating to this period, whether unpaid or paid. Okay. So now, I will take the total of the expenditure, sum, done. 31350, and here also I'm going to do the same. Make sure it's in the next column. Make sure that is just the sum of the expenditures just below your revenue. So that is easier for you to do the calculation. This is your trading profit. You should know how to calculate all this. This minus this. So under cash basis it is 3670. Here again trading profit. So it is revenue minus the sum of your expenditure, which is 36,436. So this is the answer for activity 3. At the cash basis, we have got this trading profit, and revenue accrual we got this. If you see under cash basis, we are getting less trading profit. The reason is because we have approved mileage allowance, which is reducing our trading profit. So if you see the difference between this two, it is 5786. Now, the fourth part, adjustment of profit. So as explained in section 3, most sole trader, if you see, until recently they have been preparing their accounts using accrual basis. Okay, so in this accrual basis, we have income receivable and expenses payable for that accounting period. Alternate method is what? Cash basis. This calculates taxable trading profit based on actual income received minus actual income paid. Sorry, expenses paid. But this cash basis was only available to small businesses until recently. Now, the cash basis has been made the default method for calculating the trading profit. But even then, even if the cash basis has been made the default basis, still companies or the sole trader and partners, they are continuing to use accrual basis. Why? Because they are familiar with it or they are required to use it. For example, if you are applying for a loan in a bank, they might need accrual basis. Okay. So traders who wish to use accrual basis, even though cash is the default basis, they now have to elect to do so. You have to elect to use accrual basis. You can't use accrual basis as your wish. Okay. So these are some key points under the cash accrual basis. So this section explains the process for calculating the trading profit. Next, the general rule that income must be for trading purpose apply regardless of whether the accrual or cash basis is used. See, the thumb rule is your income has to be for the trading purpose. It either it could be under cash basis or accrual basis. Basis does not matter, but income has to be for the trading purpose. Otherwise, you cannot include it as an income when you're calculating your trading profit. What are you calculating? Trading profit. So income has to be for trading purpose. Even expenses. Same for expenses. Your expenses has to be incurred wholly and exclusively for the purpose of your trade. Whether it's cash or accrual basis does not matter. Then, where there are any differences in the rules relating to the expenses which are allowable under each method, this has been highlighted in this section. So in this section, there are some expenses you can only deduct under cash basis, some under accrual basis. So those differences are highlighted in this section. You should refer to section 3 for an explanation of how trading profit for tax is calculated on a cash basis. We have just finished section 3, right? The previous section. Now, under accrual basis, what is your, see, under cash basis, your revenue that you've actually incurred is your starting point. Under accrual basis, accounting profit is your starting point when you're calculating the trading profit for tax purpose. But remember the profit in your statement of profit and loss, whether it's for unincorporated, sole trader or company, is rarely the same as trading profit for tax purpose. There are differences. That is your accounting profit that you are getting in a profit and statement. And the trading profit for tax purpose is different. You have to adjust your trading profit for the tax purpose. Because on that only you can calculate tax. You can calculate tax only on your tax adjusted trading profit. That's why you have to do all these adjustments to your accounting profits. So these are the main adjustments. Number 1, your non-trading income. Okay, if you have included non-trading income and capital profits in your accounting profit, now it has to be deducted from your accounting profit. If you have omitted your trading income, it needs to be added to the accounting profit. Then, differences between accounting and tax treatments of specific expenses. See, there are some specific expenses where these differences come between your accounting treatment and tax treatment. First, expenditure which has been deducted in your statement of profit and loss Let's say you have deducted some expenses, but for the tax purpose you can't deduct. Now you need to add back those expenses to your accounting profit. And expenditure you have not included in your profit and loss, but you have to deduct under tax purpose. Now you will deduct it from your accounting profit. So tax adjusted trading profit which is used to determine the trading profit. So for tax adjusted trade, if you're having a tax adjusted trading loss, remember your tax is zero. Okay, and for this trading loss, you can obtain relief. Okay, loss relief for tax purpose. This will cover in lecture 8. In fact, there is a whole big lecture on loss relief just to claim loss relief for various type of losses, not just trading loss, capital loss. There are so many other types of losses. Now, profit adjustment. So profit adjustment using accrual basis. Remember, this also applies for your corporation tax purpose when we study company. Because why? See, companies are not entitled to cash basis. They only follow accrual basis. It's very difficult for big companies to go by cash basis. Okay. So this will cover in lecture 17 in the future. Now, so applications to both income tax and corporation tax are discussed in the following sections. So whatever applies for income applies for corporation if it's a company. If it will be income if you're self-employed, for sole trader and partners. Okay. Now, what is the process for arriving at assessable profit for a tax year? There are 3 steps. First, and you have to follow this order. You adjust the profit of your sole trader for the period of account. Okay, it can be short, it could be long. Then you get your tax adjusted profit. You adjust the profit and get tax adjusted profit. Number 2, once you get your tax adjusted profit for the period of account, you calculate capital allowance. Okay, you have to deduct this capital allowance from your tax adjusted profit to get the final tax adjusted profit. That's why. And third is your final tax adjusted profit. So these 3 sections will examine each of these 3 steps in turn. Now we'll see each of these 3 in turn. So this is the proforma. First is your net profit. It will be given to you from your question, you can see. Then add back, do the adjustment. Add back disallowed expenditure because you have deducted while calculating net profit. Now add back. Add back the selling price of goods taken for own use. You must have deducted it. The selling price of good taken for own use. This we'll see in section 4.4.4. Deduct income not taxed as trading income. Okay. Deduct additional expenditure not already included. And before capital allowance, either you get profit or loss, tax adjusted trading profit or loss. Then deduct capital allowance. This also you have to calculate. Then you get your tax adjusted profit and loss for period of account. Remember all the proforma you need to memorize. All those proformas, small proformas. Then the general principles of profit adjustment. First, amounts credited in the accounts but not taxable as trading income. You have taken in your accounting purpose in your profit and loss account, but from the point of tax, they are not taxable as trading income. So this are usually, what are this income we'll see? They are not your trading income. Income taxed as investment income. So if you are receiving income in the form of interest, rent or dividend, they are not trading income. They are your investment income. We have covered this investment income, right, in the previous lecture. Now, non-taxable income. If you are receiving an interest on overpaid tax, remember it is an exempt. It is exempt from tax, so it's not taxable. If you take it as a taxable income, you have to take it out. Now, capital profit. So when you are selling an asset, you are having a capital profit. Okay. Irrespective of whether chargeable gain actually arise for tax purpose. So this you can't tax as your trading income. They are your capital income. Okay, on that you pay capital gain tax, not income tax. So they are not your trading income. So this amounts, they are income. You must have taken them as trading income. What did you do? You added. Now deduct. Now all these 3 needs to be deducted from your accounting profit. Okay, they might not be subject to income tax, but they might come elsewhere. They might be subject to other tax like capital gain tax. Okay, Then they do not form part of your trading income. They might be subject to income tax, but elsewhere in the individual's income tax computation, not as a part of trading income. You can tax them, for example, this dividends, you can tax them as dividend income and charge the dividend rates. Interest under savings, rent is non-savings income, but not your trading income. Okay, they are also subject to income tax, but they do not form part of a trading income. This you have to understand. Now, next, so first slot was amount not taxable as trading income, but you have taken as trading income. Next is your disallowable expenditure. Expenditure which you have deducted, now you have to add back to your accounting profit. Because for the point of your tax, they are not allowed. Okay, so the general rule when you are deducting any expenditure is it should be a revenue expenditure and it has to be for the purpose of trade. You have to see these two things. It could be any basis, accrual basis, cash basis, but it's the same rule. Okay, you can see, refer back to section 3.2. Now, section 4.4 are of the main examples of disallowed. See section 4.4 for the main examples of disallowed expenses. Now, so the implication of this rule are, if it's an under accrual basis, capital expenditure is disallowed. Just now we have seen in activity 3 previously that under accrual basis, for cars we are claiming capital allowance. We can't deduct, sorry, for equipment. We can't deduct the cost of equipment under accrual basis, but under cash basis we could deduct. Okay. Now, revenue expenses not incurred for trading are disallowed. Third, revenue expenses constituting an appropriation of profit by a profiteer. Let's say a sole trader is withdrawing the amount. They are taking drawings from the profit. What happens? It is an appropriation of profit. It is not a business expense. So that drawing is disallowed. And any private adjustments where there's a private element of an expense disallowed. For example, in motor expenses, you might use the car for your private use. That private use of car is disallowed. Even though it's a revenue expense is disallowed. And accounting estimates are disallowed. Provisions and all are disallowed. That's why we deduct them. Sorry, we add back. We deducted it before, now we add back. Third category, amounts, deductible amounts not charged in the accounts. They are deductible. You can deduct, but you did not take them in the accounts. Now you can deduct them. So the only important examples are, the first one, capital allowance. That's why we are told to calculate capital allowance. If you take it from the point of tax, for tax authority, they take it as tax depreciation. Okay. So we'll see lecture 7. In lecture 7, we'll calculate capital allowance. Note that under cash basis, capital allowance may only be claimed on car. If it's under cash basis, you can only claim capital allowances for cars, not any other. See section 3 for that. Next, business costs paid personally by the trader. You can deduct them, but they were not deducted. Such as use of office as home as office. And annual proportion of the income element of your lease premium paid for the grant of a short lease on a business. This lease we have completed in my previous lecture under investment income. Property and investment income, right? Under property income it comes. Lease premium. So there I have told you the short lease has part of income element and capital element to it. So the income element, okay, the annual proportion of the income element. This you have to deduct. It's deductible, but you did not take, now you deduct. So the tax relief is given because the accounting amortization of the lease premium or the whole premium, if that was charged against profit accounting PMVs, the lease was granted will be disallowed. Okay. This will be disallowed. So the allowable deduction for the tenant for the short lease premium paid is take the income element, deduct by the length of your lease. The income element of the lease premium is the amount that would be assessable as income in the hands of landlord. We have seen this in section 3. And lease premium will not be examined in the consumer question where the trade is using a cash basis. If you are using cash basis, they will not ask the lease premium. So now we'll solve activity 4 for short lease premium. You have to show adjustments required for taxable trading income purpose. This is a very common question in your tax. Make sure that you know all the adjustments. So Thomas has been trading for many years, up to 30th September. They have elected accrual basis. On 1st October 2023, granted a lease for 15 years. Premium is 6,000. His premium cost for 30th September, including lease amortization of 400. So now let us do activity 4. So now we need to do the adjustment. Okay. Remember lease amortization 400. This is disallowed. So this must have been deducted back then. Now you have to add it back. Okay. And you need to deduct the lease premium. So first we need to find the income element. What is the lease premium? 6,000. So lease premium is 6,000. From here we need to deduct the capital element. So from our lecture 3, we know that 2% of 6,000 into number of years. It was for how many years? 15 years. 50 minus 1. Okay. So it's 1680. This is the capital element. So if you take the capital element out of the gross premium, 4320. This is your income element. 4320. Okay, so this 4320 will be divided over 15 years. So for 15 years you can deduct them. So this you will take for 15 because we only went for one tax year, which is 288. So now 400 you have to add back, and this 288 you will deduct because it's allowable. So you are left with, so you just add this add, and this you deduct. Okay, they just told show the adjustment. They did not say to calculate anything. So this is the answer for activity 4. We have add back the disallowed lease amortization and deducted the lease premium, that is allowable. The working is here. Now the fourth category, trading income, but you have not credited them in the accounts. So the principal example is the extraction of goods from the business for personal use by the sole trader. Okay, the proprietor must be taxed on the full market value of the goods consumed, as if the sale had been made to them. So even if it is the sole trader himself taking goods for the business use from the business, he has to be taxed on the full market value, as if it was sold to him. So the adjustment depends on how the goods has been treated in the accounts. If no entry was made for the goods taken, the normal sale price should be added to the adjusted profit. If the accounts already recorded the cost of goods taken, for example drawings, then only the profit element should be added to the adjusted profit, because the cost you have already taken. With the cost, of course, you must have added a profit element. That profit element was not recorded before, now add it. Then goods for own use will not be asked in your question where the trade is using cash basis. This is the same for lease premium. Now example 10, goods for own use. So Gerald is a sole trader who sells computers and laptops. He's electing to use accrual basis. He's taking a laptop for own private use from a shop. Original cost is 2,200. Market value is 3,000. No entry was done here other than the original purchase of the laptop. That means original purchase means this 2200 was recorded but not the market value. So the tax adjusted trading profit should reflect this transaction as if Gerald has sold the laptop to himself. So only the original purchase was recorded. Adjustment should be to add the market value of 3000 onto the accounting profit. That's the market value. This you have to add to the accounting profit. Now, next category, the fifth section of this lecture, disallowable expenditure. This itself is a big lecture. Big section is on this. You see how important this disallowable expenditure is. Very, very important. Because this is a very common area examiner is going to ask you in your tax, whether it's ATX or wet tax. Why? Students often make mistakes in this area. Thinking an expenditure is allowable, they deduct, but in fact it's disallowable. Or if it's disallowable, they don't deduct. They don't do the adjustment. So first expenditure which is not allowed for you to deduct from your trading profit is your trading income, is your capital expenditure. Okay. So this adjustments explained in this section, this is only for accrual basis only. When your trade is prepared on accrual basis only, it is for this adjustment. You should refer to section 3 for an explanation of expenditures treated under cash basis. See, if it's a capital expenditure, there is no difference between revenue or capital if you are using cash basis. The moment you have incurred an expenditure, whether it is capital, whether it is revenue, you deduct from the trading income. The difference only comes in accrual basis. So all these adjustments from section 5 onwards applies only for accrual basis. Accrual basis, not cash basis. So in a capital expenditure, your depreciation and amortization, they are disallowable because they are accounting adjustments. Okay, they are non-cash expenditure. They are disallowable. You must have deducted them when you were calculating net profit. Now add. So you have to add back your amortization and depreciation. Add back to your accounting profit. The most important aspect for capital expenditure is your repairs and improvement. You have to identify whether it's a repair or improvement. Why? If it's a repair, it's a revenue expense and it is allowable. If it's a improvement, it is a capital expenditure and it is disallowable. So you have to understand what is a genuine repair and what is an improvement to an asset. For example, if you are incurring a cost to replace an asset or you're making a significant improvement to that asset, it's a capital expenditure. Now, what is a repair? A repair means it restores an asset to its original condition. That is known as repair. But if you're using a modern material, it does not mean a repair becomes an improvement. If the original materials are no longer generally used, let's say 5 years back you have used a material. Now you find the equivalent but a modern material. So it does not mean it's an improvement. It is still a repair only. For example, you are replacing a double single glazed windows with a double glazed windows. Okay, so this is treated as a repair still, not an improvement. So replacing a part of an asset is also a repair. If you are replacing a part of an asset, that is a repair. But if you are replacing the whole asset, it's a capital expenditure. Sometimes it's very clear what the asset is, but sometimes asset could be considered as a separate asset or a part of a bigger asset. In that case, it's difficult for you to identify, distinguish clearly which is repair, which is improvement. Repairs to a newly acquired second-hand assets when the purchase price is reduced. Okay. And the asset is not capable of trading use before the repair. This is capital expenditure and it is disallowed. See, when you have reduced the purchase price because you are repairing it, you are taking into account the repair. That's why you're reducing the purchase price of that asset. And the asset, you can't bring the asset to trading use before repairing it. Then this is a capital expenditure. This is disallowed. Now, But the initial repair, the cost of initial repair, this is allowable. Okay. If the asset can be used in trading before the repair set, that means before carrying out the repair, you can use the asset in the trading. So that initial repairs are allowable. Okay. If the repairs are for normal wear and tear and the purchase price was not adjusted to take account of the repair work, that means the purchase price you're not deducting it because of the repair, and that repair is for normal wear and tear, it is allowable. Now, there are some incidental costs. For example, legal expenses. You have incurred this to acquire non-current asset. They are capital expenditure. They are disallowable. But incidental cost, that means because of this cost you are incurring. Okay, so incidental cost of renewing existing short lease. Short lease means 50 years or less. This is allowable. The cost incurred to renew an existing short lease, these are allowable. Incidental costs incurred in raising a long-term finance, they are capital and they are disallowable. So as mentioned above, treatment of capital expenditures has different rules under cash basis. Next, expenses not wholly and exclusively for trading purpose. This is a big list. We'll go one after the other, which comes under this category. First one, subscription. So if your subscriptions are not your professional subscriptions, they are disallowed. Next, entertaining and gifts, disallowed. But the following are allowable. If it's a staff entertaining, business free sample, other gifts provided that they bear are advertisement for the business, the cost is less than 50 per donee per year and they are not food, drink or tobacco, then those gifts are allowable. If you are giving a free sample, allowable. Staff entertaining, allowable. Gifts to employees are also allowable. Although, if you are giving a gift to an employee, remember the gift that an employee is receiving, on that there is an income tax charge for an employee. Now, third category, donations to non-trade related organizations. Donations, so these are the donations which are for non-trade reasons. If you are donating anything to political parties, they are disallowed. Small donations to local bodies, for example, for educational purpose, religious, cultural or recreational, they are allowable. Okay. So to be allowable, donation has to be for trading purpose. And the advertising, example, advertising. They must be a reasonable size in relation to the business and must be made to a registered charity. If the charitable donations do not meet these conditions, they are disallowed. But because you are donating under charitable donation, under the gift aid scheme, this we have covered in lecture 2, you can get some relief. Now, the fourth category, leasing car cost and hire purchase. Only the business portion you can deduct of the leasing cost. The private portion of any car leasing charges is disallowed. In addition, leasing cost of the car with the CO2 emission exceeding 50 must be adjusted by adding back 15% of the leasing cost. So that means 85% of the cost are not allowable, but 15% is allowable. So 15% you add back. If your car exceeds 50 grams, okay, emission, the CO2 emission is more than 50. Otherwise, this adjustment is not required. Your full amount is not allowable, is disallowed. No restriction if car has CO2 emission less than 50. What about hire purchase? Leasing cost we have finished. Now hire purchase. Interest on a hire purchase is a trading expense and it is deductible. These rules do not apply under cash basis because under cash basis, the moment you incur the cost, hire purchase lease cost you deduct. So example 11 will help you to understand the leasing cost better. Carol is a sole trader and have elected to use accrual basis. She has incurred annual leasing charges 4,000, CO2 emission is 80, and uses 30% for private use. So now we have to find out the allowable leasing charges and the disallowable leasing charges. Remember, the disallowable will be added back. So the allowable is 85% because the disallowed was 15%, and the private use. So what is allowable? 30% will be disallowable, the private use. So allowable will be 70%. So 70% on the leasing charges, 70% on 4,000, 2,800, and on this you have to take 85%. So this is allowable, 2,380. So disallowable, just deduct it from 4,000. The alternate way of doing this is take 30% of 4,000, that is a private use, and now take 15%. Add both. This is 1620, 1620 is the same. You use this or this is the same. The ultimate aim is you have to find out the disallowable charges part. But I find this is easier. This way is easier and it saves time. Now, next expense, accounting fees. See, accounting fees are disallowable. Accounting fees for preparing an individual's personal tax return. Why? Because it's a personal expense. But if the accounting fees is for the preparation of business accounts, that is allowable. Now, accounting fees incurred in dealing with an HMRC inquiry are normally it is disallowable. But if the inquiry relates to trading income and there are no additional profit that are brought into charge as a result of the inquiry, then it is allowed. And remember, your charges, you are not to be found guilty of careless or deliberate behavior. Okay. Legal fees, the next expense. So legal fees, if it is regarding capital expenditure, it's disallowable. But if it's a renewal of a lease, short lease, it is allowable. If the legal fees is in terms of revenue expenditure, that and it is for trading purpose, is allowable. Now, travel and subsistence payment. So any cost incurred by a sole trader for traveling from home to workplace, disallowable. But other business travel expenses are allowable. Subsistence cost. Generally, they are disallowable if it's not for the purpose of trade. But if the expenses are incurred by the sole trader while traveling for business purpose, it would be allowable. But remember, if the business travel itself is allowable, business travel has to be allowable, then the expenses, the subsistence payments will be allowable. The next expense, cost incurred partly for private use. Okay. If there are any expenses, okay, where there are portions, some portion is for business use and some has a private use to it. Normally, strictly speaking, the whole amount should be disallowed in that case. But now HMRC is saying they will accept the private use portion of the cost being added back. Before the cost was deducted, now add back. So private use portion you add back. For sole trader, expenses like telephone expenses, they're very common, motor expenses. This can have both business use and private use to it. Okay. So in this case, for telephone expenses, okay, for telephone expenses, any line rental animal will always be treated as private use. The rental element is always private use because we do not use it for business. You cannot use it exclusively for business use. But the cost of call, you can apportion between the business and the private use. Rental part is always private, disallowed entire portion. But for calls, the cost of call, yes, you can apportion. Private part, you add back. Now, website cost. The cost of setting up a website is a capital expenditure, disallowed. But the updating the website are revenue expenses and allowable. First time you are setting up a website, not allowed. But thereafter you are updating the website, it's allowable. Next, fines and penalties. They are disallowable. But if it's a parking fine for an employee while that employee is on the business, it's allowable. But remember, it is not on the director or the sole trader. For them, it is disallowable. It is only on employee. Okay. That parking fine should not be by the sole trader or the director. Next, the cost resulting from fraud, disallowable. Not only by the sole trader, but also if the fraud is done by the employee in that position of control, disallowed. The cost of petty theft and pilferage, which are not covered by insurance, are allowable. Okay. Impairment losses, the 12th expense. Okay, these numbers will help you to decide. So this is impairment loss 11, 12th. Impairment losses, you have to see whether it is on trade debts or non-trade. If it's on non-trade debts, disallowable. Such as you are writing off loans to former employees or suppliers. Therefore, non-trade, it's for non-trading reason on employees or suppliers. But if it's on a trading debt, impairment loss are allowed. So such debts subsequently recovered are not taxable receipt. If subsequently you are receiving from them, from your employees and suppliers, that means the amount of the loan. Now the employees are repaying it back to you or the supplier. See, you're receiving it, that means it's taxable, right? But here they are saying if you're receiving such debt, they are not taxable receipt on you. Even if you receive it, you don't have to pay tax on it. And impairment losses on trade debts are allowable. Interest payable on loans for non-trade purpose. Of course, it's not allowable because it's for non-trade purpose. Non-trade purpose means you have taken a loan to purchase to purchase or to improve a lead property. Lead property is not trading. Now, so interest on late paid tax is disallowable. And interest on overpaid tax is not taxable income. That means if you are receiving any interest on the overpaid tax, because you have paid more tax, you are receiving an interest, that interest is not taxable income. It's not a taxable income in your hand. So this will only need adjustment if they have been charged or credited. You only have to adjust if they have been charged or credited. If no adjustment was there, you don't have to do any adjustment if it was not charged or credited. Now, interest payable on loan taken for trading purpose is allowable. Let's say you are taking including interest on business account overdraft. Now, so that's it. Expenses incurred. Now, if any drawings by the sole trader. So cash was withdrawn by the sole trader as disallowable. Okay. Cash withdrawn by property of an uncovered basis that constitutes remuneration, such as including payment of your personal tax and class 4 NIC. Disallowable. But if the remuneration, remember the remuneration of a company director is an allowable expense. Okay. It's for corporation tax. This is for corporation tax, not income tax. When you're doing company, there you can deduct this. Any remuneration paid to company director, you can deduct as your allowable expense. Even if the director is also the shareholder of the company, still you can deduct. Now, personal use. So personal use of business assets by the proprietor is disallowed. Example, they are using car premises. And personal expenses of the sole trader paid by the business also disallowed. Now, the cost of providing employer owned assets. That means employer is owning the asset, they are giving it to employee to use it. Even the shareholders, even the directors are using it, okay? Including direct shareholders of a company. In that employee, the director shareholders also included, or paying their personal expenses. That means the employer is paying for the or paying their personal expenses. They are tax allowable trading expense for the employer. So if the employee is paying for the personal expense of the employees, or they are giving them an asset which was previously owned by the employer, still is owned by the employer only, but employees are using it. They're privately using it. Or the personal expenses of employees are paid by the employer. For employer, they are tax allowable trading expense. That means you can deduct this expense from your trading profit. Why? Because the private benefit is treated as an assessable income of the employer. Remember, the benefit that an employee is receiving, because employer is paying for these expenses or giving them an asset, is a benefit for employee. For employee, it's an income in the hands of the employee. In my previous lecture, we finished employment income, right? So there we studied all the benefits. There we studied two types of benefits. One, your personal expenses are paid by the employee. The other one is use of an asset owned by the employee. So these are benefits. Now, any salary paid to a family member is an allowable expense, provided it is not excessive. Remember, the salary that you are giving to a family member has to be in the same rate that you are giving to your other employee for the same work. The excessive amount is disallowed. The excess is disallowed. The excess remuneration. Now, the last part of this lecture. Pre-trading expenditure. Expenditure incurred before you start trading will be treated as the expenditure you have incurred on the first day of trading for the tax purpose. Okay, it is same under both the cash and accrual basis. So any pre-trading expenditure will be treated as incurred on the first day of trading. Now, you will be given relief. So if you have incurred any pre-trading revenue expenses, you are going to get a relief. So this is incurred up to 7 years before the trading. That means 7 years from the before you start trading. Any expenses you have incurred which are revenue expenses, you are going to get tax relief now. It has to be revenue, not capital. So here, even though it is 7 years before trading, they would be treated as they were incurred after the start of trading. Okay. Remember that revenue expenses that you have incurred has to be a trading expense, allowable trading expense. So under the cash basis, how are you going to get the relief? So remember, under cash basis, you are going to get relief for the capital expenditure also. Pre-trading, before trading you have incurred any capital expenditure, now you can deduct as your trading expense. You can deduct as your trading expense incurred on the first day of trading. This is for plant and machinery. And for cars it's not like that you have bought a car and you deduct that amount. No, for cars, if it's a cash basis, you will be given relief by a way of capital allowance. Okay, you claim capital allowance for it. So the relief is given by a way of capital allowances. Now, under accrual basis, both plant and machinery and car, the relief will be given by capital allowances only. So for cars, capital allowance is only under cash basis, but accrual basis, all the assets capital allowances with the car. This is for pre-trading capital expenditure. Now, no adjustments for tax purposes required to the trading profit shown in the accounts unless the expenditure is capital expenditure, which has been incorrectly written off instead of being capitalized. That means you have deducted it. You should not deduct capital expenditure, add back. Or the expenditure was a revenue expenditure that would not satisfy the condition for tax relief. So add back. You have deducted it, but you can't deduct for tax purpose, no add back. Or Expenditure is a revenue. It satisfied the condition of tax relief, but the amount was ignored. Now deduct. So these are some key points you need to remember. In order to obtain all the marks in your exam, okay, in addition to any adjustment required for tax purpose, those items referred to in the question which do not require any adjustment, you have to still show in your answer with a 0. You just can't ignore it. Okay, so in this case, you don't have to give an explanation. Writing 0 itself understood that you have understood the correct treatment. But if you have omit the answer, if you have omit the item from your answer, examiner will not know whether no adjustment was required or you forgot or you have accidentally missed the item. So you should only provide an explanation for the treatment of an item if it is specifically asked. If they ask for the explanation, then only give, otherwise don't give. Otherwise just showing 0 is enough. Examiner will understand. Now, activity 5, the last question of this lecture. With this question, we'll understand the entire lecture. Because in this question, we have to do all the small areas that you have touched in the previous slide. So, Brian started trading as a retailer on 1st Jan 2017, preparing annual accounts to 31st December. They have elected accrual basis. Now, you have been showing the accounts. Okay. So, gross profit, profit on sale of plant and machinery, savings income was saved. You see various types of incomes are there. All are not for trading income. Now, wages for staff and wife has been given. Then, premises, rent, business rates, council tax, water, gas, telephone, call charges, repairs, maintenance given, motor expenses, leasing charge, running cost, advertising, promotion, depreciation, some expenses, professional charges, everything is deducted from gross profit and you have ended with the net profit 74,690. Now, there are some notes. So we'll read the notes. Brian's business wife works part-time for the business. Her wages are equivalent to those payable on an unrelated business carrying out similar duties. No adjustments required because same wages. Her wife is not receiving an excess wage. Second, business premises all the users home, the private element is 60%. Business use of telephone is 80%. Repairs and maintenance. So they have given how this 10,000 has arrived. They have given the breakdown. This is redecoration of private homes. This is for new fittings and painting and repairs. And then lease the car with the CO2 emission 125. Then sundry expenses, stationery, painting, cleaning of shop. Then donations to political party, local school, entertaining, customer, staff. Then fine for motoring and interest. And then pension, personal pension contribution. Then professional charges, accountancy and debt collection. And then finally, you can ignore VAT. Eighth, the last one. Brand has received goods for his own use that cost the business 250. So this is what appropriations by the sole trader. Drawings. This cost has been currently recorded in purchase but no other entries has been made. The selling price of the good was this. Calculate the adjusted profit. So now let's do that. Activity 5. So now we'll start activity 5 from our net profit. It's very important that you should know your starting point. Okay, so this is the place we'll start from. Net profit 64,690. Now, so we have to do the adjustments. So let's start the adjustment given in the order. First one, profit on sale of plant and machinery. This you have to deduct because this is not a trading income, but they have added there. So we'll deduct. It was added. Now we'll deduct the 300. Profit on sale of machinery. Next, so number 2 is your savings income, 1,600. This also is not saving, it's not your trading, you have to deduct. $1,600. Next, your wages. One is to the staff and the other one is to the wife. Okay, so staff and wife both is the same amount, 42,700 they have given. They did not give you the breakdown. So now, if you see for wages, there is a note. If you see her wages are equivalent to those to the unrelated person. So in this case, you don't have to do any adjustments. Full amount is allowable. So you don't have to do any adjustment. Even though you don't have to do any adjustment, you have to write it. You have to show it. So how are you going to show it? Write wages and staff and wife. Remember what you can for which you do not need adjustment. It is a reasonable amount. The one which you are giving to the other staff, same you are giving to the wife. So the reasonable amount is allowable. That means no adjustment required. So you will show 0. Next, premises. So when we come to the premises, remember here they have told the private element for business premises is 60%. That means up to 60% it will not be allowable. For that 60% you have to do the adjustment. 40% is business expense, you can deduct. So coming to the rent. So if you see here, this is 6,000. Okay. Oh, I'm sorry. This 42,700. This 4,000 is for the wife. Okay. That 42,700 is for the staff. The reason is there's a space in between. That's why I got a little confused, thinking that 4,000 was rent. The rent is 6,000. Remember, private element only is the one where unit adjustment. That part will be disallowed. So it was deducted before. Now you have to add it back. The expenses add, income deduct. So 60% of 6,000 you will now add back for rent. So 60% into 6,000. 3,600. Next, after rent comes business rates. The next one. So 4 is your rent, 5 is your business rates, which is 1,000. For business rate, it is allowable. They haven't mentioned anything. So no adjustment required for business rates. So business rates, 0 adjustment. Then we have council tax. 6th is the council tax. Okay. For council tax, remember the entire amount is private use. So this is not allowable. Add back. The full amount, 600. Because it's fully private. Next, water, gas, electricity. This. Regarding the premises, remember premises 60% is private use. So water, gas, electricity also you have to take 60% of it. So 4,000. So I'm not writing the entire description, I'm just writing water. Rest all you can fill. Private is 60% is the premise, so water also will be 60%. Any expenses related to that premises, you have to take the private element, which is 4,000. So 2,400. Next. So it is 7. Now 8 is your telephone. There is rental, no separate business line. So that 100, fully it will not be allowable. Rental are always fully private. Telephone. Hundred, the full amount is not allowable. So disallowed, you add back. Coming to the call charges. Call charges. So the next is call charges, number 9. Is 1650. So regarding call charges, business use of telephone is 80%. So that means only 20% will not be allowed. So 20% of 1650. Add back. 330. Next are your repairs. Repairs and maintenance, number 10. For this we have a note. So this 10,000 is shown here. Point number 4 under note 4. Okay. So redecoration of private room. It's a capital expenditure, not allowed. So 3,000 add back. Redecoration. Then refitting of shop, new fittings, 4,400. Again, this is capital, not allowed. Sorry, redecoration of private room is not capital expenditure, but it is not allowed. And new fittings, because it's private room. New fittings is a capital expenditure, 4,400 not allowed. New fittings. It's capital. Disallowed. Only the disallowed you have to do adjustment. So it's 4,400. Then painting and repair, 2,600. This is allowed, but still you can't ignore it. Okay. So painting, since there are no adjustment required, that is allowable, just write 0. Then (11) leasing charges. So under leasing charges, COT machine is 125, more than 50. So 15% is disallowed. 15% of the leasing cost. Leasing cost was 5,000. So leasing, if you take 15% into 5,000, this is disallowed. Add back 750. Now the running cost. Okay. If you go and check the running costs, 3,000. This running costs are allowable. So running cost, no adjustment, you write 0. Now, what's the next expense in the list? Advertising and promotion. Advertising and promotion is for trading purpose in this case. They haven't mentioned anything, did they? They haven't. Okay. So here, advertising and promotion is allowable So next to that we'll write 0. Next expense is your depreciation. So depreciation is disallowed, 2700, disallowed. Add back. $2,700. Next, we have the donations under sundry expenses. So here, sundry expenses. For sundry expenses, there's a note. There's a breakdown of those sundry expenses. Okay. So here, stationery and painting. Stationery and painting, this is allowed. So stationery allowed, 0. Then we have cleaning of shop, 2400. Cleaning of shop is also allowed. So it is 0. Then we have donations. Okay. Donations to local school, 100 is allowed, but political party is not allowed. So political party 300 we add back. Donation, political, 300. Okay. School, 0. Then entertaining. Entertaining customer is disallowed, but stuffed Christmas party is allowed, 150. Entertaining customer disallowed, so add back 600, and staff is allowed, so 0. Then we have the fines. Motoring, brine, and the interest on overdue tax, 60. So if you see the total, this is not allowed, disallowed. Okay, both motoring and interest. So fine is disallowed, 160. Add back. Either you can show 160 separately. Then pension contribution. So this pension contribution, Ben's policy, it is personal pension contribution, not allowable, 2600. So pension 2600, add back, disallowed. So now we have finished the entire list of sundry expenses. You see. Now we are left with professional charges, 1850. This also there's a breakdown. Okay, under note 7. So accountancy and legal charges. So the professional charges, accountancy as well as the legal charges regarding the debt collection, the entire amount is allowable, so no adjustment. So professional charges 0. Professional charges 0 because no adjustment. Last, it's goods for own use. The eighth point. So goods for own use. Okay. Now, what should you do? This is the cost. Cost was correctly recorded, but the selling price was 2750. This was not recorded. This you have to record. 2750. So this will be added. Now, so the before capital allowance, this is your adjusted profit before capital allowances. How much? 97,080. So this is the answer for the last activity, that is activity 5. Now, so we started with the net profit. Profit on sale and savings income, since these two are non-trading income, we deducted, and other expenses which are disallowed, we have added back. For wife, because it did not exit, no adjustment. So wherever no adjustments are there, it is showing you 0. Okay, all the business things you deduct, anything personal non-trading you add back, the expenses I'm talking about. So it's the same thing, and then you arrive at this adjusted profit before capital allowances. Now that's it for this lecture. So from your syllabus, we have covered section B, income from self-employment, the third section. So we have recognized the basis for assessment for self-employed income under both cash and accrual basis. Then we applied barriers of trade. There were so many barriers of trade which helps you to decide whether you are employed or self-employed. Then we recognize the expenditure that you can deduct from tax adjusted trading profit, from your trading profit to arrive to tax adjusted trading profit, and the relief obtained from pre-trading expenditure. So let us summarize the entire lecture. So we started with the badges of trade which HMRC applies to determine whether your profit is an income, trading income, or a capital gain. If it's a trading income, you apply income tax. If it's a capital gain tax will apply. Okay. So next, sole trader. For sole trader and partners, we are still in the sole trader. We haven't touched partners yet. Okay, but it applies to both. Sole trader and partner, they are assessed on a tax year basis from 2024-25. That is the tax year that you are going to give your exam. Profit, you have to apportion your profit if your accounting profit is not from 5th April or 31st March. Okay, the year end. For commencement, if you have just started the business, this is how it will run from the date of the commencement to 5th April. And if you have ceased, then from 6th April to the cessation date. And the transitional profit are apportioned and spread over 5 tax years, starting from 23-24 to 27-28. Then sole trader and partners, they use cash basis, but they can elect for accrual basis to calculate taxable trading profit. Under cash basis, capital items are treated as trading expenses. So if you have bought a machinery with your cash, you can deduct from your trading income. Same, they are treated as trading expense, that's why. But remember, only machinery and van, but not cars. Cars are not treated as your trading expense. They are treated different. Okay. Then for sole trader, once again, a simplified version of fixed rate expense, you can deduct a fixed rate. This is available for the business cost of your vehicle, private use of a business premise, and use of home as office. For 3 type of expense, you can deduct fixed rate of expense, not for all the expenses. Then under accrual basis, accounting profit is your starting point. We have just seen in the activity 5 where we start with the net profit. Then these are the adjustments to your taxable profit. If it's a non-trading income, like we have seen, for savings income, dividend income, we deduct. Okay. Capital allowances, we deduct. Then drawings and disallowed expenses. So these are the adjustments. Because of this, there could be changes to your taxable profit. Expenses are generally disallowed if they are not for your trading. And pre-dating expenditure, that means expenditure incurred before you start trading, will be treated as they were incurred on the first day of your trading. Now, these are the technical articles you have to read on your ACCA website, that is adjustments of profit, for this lecture. Thank you for watching, and I shall see you in lecture 7. And meanwhile, do not forget to subscribe to my channel if you haven't subscribed. You can also join my channel and become a member on my YouTube channel so that you can watch my ATX lectures. They are available only for my YouTube Gold members. Thank you.